Hi, it's Moya here, Chief Currency Strategist and Head Forex Educator at Trading Advantage. Welcome back. I'm so glad you're here to watch this third and final video. Like I've said before, I believe to trade Forex successfully, you need to take a three-pronged approach to your education. In the first video, I showed you what I believe are the proper risk management techniques you need to keep trading successfully in the long haul. In the second video, I gave you a technical strategy that I believe you can immediately apply to your trading. Lastly, in this video, I'm going to give you the final tool that I believe you need for consistent Forex success. How to incorporate fundamental analysis into your trading plan. Because let's face it, trading Forex isn't easy. There are a lot of factors to consider. In my live signal classroom, I'm constantly incorporating all of these elements and showing you how you can apply them in real-time market conditions. First, let me get this disclosure out of the way. The macro warning using key fundamental drivers. There are a plethora of fundamental catalysts that can trigger a new shift in momentum. With over 80 economic indicators for the US economy, it is nearly impossible to explain how the Forex market will react to each release. Remember that we must also focus on the fundamental for the other half of the currency pair. Fundamentally, market timing the Forex market requires you to first find a strongly trending currency pair. The key catalyst may be a country about to exit a recession or the unveiling of a new central bank policy. When the global economy stabilizes, we will also focus on inflation. We often will see these paradigm shifts have the buy the rumor, sell the news mentality, so it's important to identify these potential turnarounds. Balance sheet size. A major central bank theme in 2012 and 2013 is that the whole world is in austerity mode. Eventually, this limitless pumping liquidity into the system will have to end. How is the Fed going to unwind their balance sheet? What will they do when interest rates are forced to go higher? These are all questions that will eventually provide us with some very strong currency reactions. History often has a habit of repeating itself, and we should expect the Fed to act slow. On the other side of the Atlantic, you have the Eurozone, and you can see from these Bloomberg screenshots that both have greatly increased their balance sheets during the financial crisis. But the ECB has been tightening their balance sheet, while the Fed keeps the QE pedal to the metal. In the end, we could expect a currency whose central bank has the tightest balance sheet will be poised to appreciate against the less fiscally responsible ones. U.S. jobless claims. The sobering reality of the U.S. economy has been rather depressing. Despite how bad things got, the dollar remained relatively firm as it has benefited as a safe haven trade to the high beta currencies. One key statistic that has helped provide a dose of clear thinking is jobless claims. This statistic has been steadily improving, and along with it, we've started to see improvement in the employment situation and the overall general health of the U.S. economy. In the end, you need jobs to grow GDP. You will not buy a house if you're unemployed. Consumer spending, which makes up 66% of GDP, will suffer if the average American is not making ends meet. Business will contract and inflation may climb as demand falls. It's a vicious cycle, and we will expect central banks to do their best to help strengthen the economy. So what drives commodity currencies? Each commodity currency has something that is typically correlated with its strength and weakness. The Australian economy is rich with several raw materials, especially iron ore. This happens to be its largest export to China. You'll notice that traders often become fixated with these correlations, but one must always remember that correlations are never 100%, and sometimes we may see a larger theme that may drive a specific move in the currency markets. A slowdown in China could lead to weaker demand for Australian exports, which in the end could hurt GDP and eventually lead to a weaker Australian dollar. You will see in the live trading room that we will track each economy's structural and cyclical themes. Bond yields. Before we go into bond yields, I'd like to point out that the euro is flawed. In order to have a chance to have a strong currency, and a currency that will survive, you need to be able to implement fiscal, political, and monetary actions effectively throughout an entire economy. The euro has 17 members who have very diverse situations and initiatives. When bond prices fall because demand is weak, you will see bond yields rise. The 10-year yield are what we use to study the southern periphery countries in Europe. The reason being that the ECB has the ability to buy all the short-term debt. By tracking bonds, we're able to identify when contagion concerns could become a reality. Recessions. Economies go through cycles, periods of economic expansion and periods of contraction. Recessions are closely analyzed in FX because it will often prompt a central bank to take a dovish stand, and that could ultimately lead to a weaker currency. To stimulate economic growth, the central bank might lower interest rates to help give the economy a boost. In the US, the Federal Reserve kept pumping money because inflation was not a concern for them. This unlimited quantitative easing has propped up commodity prices and helped bolster up all the stock markets. You'll notice that other central banks are also exercising their right to use QE, and the effects are initially very damaging to one's currency. Now that we have a fundamental bias, we can look at the charts to find a strong trending opportunity. We'll first take a look at the weekly chart on the left. Price should be trending strongly with both the 100 and 50 period simple moving average on the weekly chart. In a downtrend market like in our example, the shorter period SMA will be below the longer term SMA. If we were analyzing an uptrend, we will require the shorter SMA to be above the longer term. In this example, the highlighted blue box also highlights the moment the trend turned bearish. On the daily chart on the right-hand side, we'll focus on the 200-day and the 50-day simple moving averages. The setup is invalidated if price closes through the 50-day simple moving average time period. We will require both criteria for each respective SMA be in the same direction on both the weekly and daily charts. Exceptions are rare and only justified if the market positioning is still strongly firmed and the move tested the SMA was an exaggerated move that happened during a thin market. It is typically highlighted by a long wick that briefly penetrates the 100-day simple move. I'd like to point out that the backdrop behind what is driving both trade and capital flows will constantly change, and that's why we will use longer time period charts to identify such opportunities. This applies to any combination of currencies involving the majors, which are the US dollar, the euro, cable, the Chinese yen, the commodity currencies, which include the Australian, New Zealand, and Canadian dollars. While analyzing our daily charts, we will rely upon our Fibonacci levels to identify our entry point. We will target the 23.6 and 38.2% retracement levels of the most significant high-low move in a downtrend, just like in our example. It would be a low-to-high move for an uptrend. We will then enter half our position at the 23.6 Fibonacci level and the other half at the 38.2% level. You may also find a bearish ABCD pattern for added confirmation on the shorter time period as well. In a bearish setup, stops will be determined by a 10-pip stop loss just above the high of the prior candle that had price trade through the 38.2% level on the original high-to-low move. You may also look to find ABCD patterns to confirm the move on the shorter time period, such as 60-minute or 30-minute charts. Regardless if you're holding one or two positions from the medium-term trade setup, you will draw trend lines to highlight the acceleration. Alright, starting over. Regardless if you're holding one or two positions from the medium-term trade setup, you will draw trend lines to highlight the acceleration of the price move. You will likely need to redraw trend lines and make sure you use the most recent levels that identify a significantly tested trend line. Significant highs and lows work best. It's also a plus if the trend line has multiple touches. In this example, the blue trend line started with a significant high that reflects the beginning of this downward move. After our trade has been triggered, we waited for the corrective move to resume bearish price action. You will notice that our trend line highlights the high point of the corrective move. We then rode this all the way down until price ultimately touches the trend line. Trilogy of Trading. My 3 videos covered a lot, and I especially want to point out that everything is constantly reinforced in the live trading room. The 3 keys to trading are risk management, applying technical analysis, and understanding the fundamental drivers of the market. The first video gave you the commandments and the risk calculator. This will hopefully help you avoid some of those pitfalls that hit most FX traders. The second video touched upon one of my favorite technical strategies, the ABCD pattern. That pattern also reinforces some of the strong disciplines required in trading. The third video also showed you how you can identify a trend. The key focus, though, of the third video was explaining to you how fundamentals do matter. Learning fundamentals, however, will take time, and you'll notice that most fundamental drivers are constantly changing. In our trading room, you'll also learn how market positioning is affected by these drivers. And just when you think the world is yours and the market makes sense, it changes. You'll notice that you'll need to adjust your trading models and acclimate to the main drivers of the FX market. Market psychology and education and reviewing your performance is also something that everyone should focus on. You can take a look at any profession and you'll see it often helps to learn from someone who has been there before. The interactive live trading room will go over all these key lessons and all the major market themes for you each and every day. I encourage you to get on my VIP list, because if you don't, you're going to miss out on all the opportunities to learn how you can immediately apply my proprietary strategies to your trading. When you get on my VIP list, you can start following my trading signals and learn what is happening in the Forex market in real time in my live signal classroom. But there are only a few spots for a limited number of VIPs. Forex is the largest and fastest growing financial market, but you need someone to help you navigate through the murky waters. For a limited number of VIPs, I'll be there to mentor you one-on-one during prime market hours. You could spend the next couple of years or more trying to learn to do it yourself. And while real-life trading experience is necessary for one to become a seasoned trader, you will be able to accelerate those valuable lessons that every trader needs to go through by becoming a VIP member and learning different lessons on market psychology, market positioning, macro and technical drivers, and more every day in my trading room. I look forward to seeing you guys. Thank you.